In 1493, a Spanish sailor stepped off a ship in Seville, carrying gold he had never earned. That gold did not come from trade, from craft, or from any labour performed on European soil. It came from a continent that most people in Seville had not yet heard of, extracted by force, loaded onto wooden ships, and carried across an ocean that had no name on any map. Spain was about to become the wealthiest nation on earth. 5 centuries later, 1 in every 8 Spanish workers cannot find a job, and among young people under 25, that number exceeds 30%. The gold is gone, the empire is gone, and the question that no one has fully answered is where exactly it all went. By the early 16th century, Spain controlled a landmass larger than any empire Rome had ever administered. The Spanish crown claimed dominion over the Caribbean islands, the entire coastline of South America, and vast stretches of North America. This was not symbolic authority. It was enforced by soldiers, backed by law and funded by extraction. At its peak, the Spanish Empire spanned approximately 13 million square kilometers across 4 continents, dwarfing every rival power in Europe. The mechanism of control was straightforward. Conquer the territory, subjugate the population, and redirect the resources back to Castile. Silver was the engine. The mines at Potosí, located in present-day Bolivia, were discovered in 1545 and immediately became the most productive silver source in recorded history. Within decades, Spanish galleons were crossing the Atlantic loaded with ore that would reshape every economy it touched, from Seville to Shanghai. The crown held a legal monopoly over this flow, taxing 1/5 of all extracted metal through a levy called the Quinto Real, the Royal Fifth. No private bank, no merchant guild, no foreign state had ever commanded a revenue stream of this scale before. By 1545, the Spanish crown controlled a territory larger than any empire in recorded European history. Silver convoys from Potosí arrived at Seville's docks in quantities that made the city the wealthiest port on earth. The mint at Potosí stamped so many coins that the Spanish peso became the first currency used on every inhabited continent, the first true global reserve currency. King Philip II ruled from Madrid over the Americas, the Philippines, Naples, Milan, and the Low Countries simultaneously. No single monarch in European history had ever commanded so many soldiers, so many ships, and so many sources of raw revenue at once. Papal decrees had already divided the non-European world between Spain and Portugal, and Spain had taken the larger half. Spanish theologians, Spanish generals, and Spanish bankers all shared one operating assumption in the 1560s. This structure was permanent. The fleet system, the Armada de la Guardia, ran like a machine, galleons departing Seville each spring, returning each autumn, loaded with certified silver. Think of it as the 16th century equivalent of a sovereign wealth fund with guaranteed annual deposits and no withdrawal limits. That is the moment historians mark as peak confidence, when the system appeared not merely powerful, but self-sustaining. The silver extracted from Potosí and Zacatecas did not stay in Spain. It moved through Spanish hands like water through a cracked pipe, paying foreign creditors before it could build anything domestic. Castile borrowed against future silver shipments from Genoese and Flemish bankers, pledging coin that had not yet crossed the Atlantic to fund wars that never ended. By the time the treasure fleets docked at Seville, the silver was already spent on paper. Economists call this mechanism monetary inflation without productive investment, an economy flooded with money that buys imports instead of building industry. Spanish prices rose sharply after 1540, pushing domestic craftsmen out of markets they had once supplied, because foreign goods bought with silver were simply cheaper than anything made in Castile. The weaver in Toledo closed his workshop, the ironmonger in Bilbao lost his contracts, the merchant in Burgos stopped manufacturing and started importing instead. Spain became a transit corridor for wealth. Silver entered the port of Seville, moved immediately to Antwerp and Genoa as debt repayment, and continued east into Ottoman and Asian markets for spices and silk. The Spanish crown received the metal, but Flemish weavers, Italian bankers, and Asian traders captured the lasting economic value embedded in that metal. This is the structural trap that modern economists recognize in petrostates, a resource windfall that inflates costs, hollows out local production, and creates dependency on the very imports the windfall finances. Spain did not lack wealth in the 16th century. It lacked the institutions and incentives to convert that wealth into compounding productive capacity. The empire mined the world and built nothing durable with the proceeds. In 1647, a crowd of starving workers gathered outside the royal mint in Seville, and guards turned them away at the gates. By that year, the Spanish crown had defaulted on its sovereign debt 4 times in under a century, each default wiping out the Genoese bankers who had kept the empire funded. Philip IV sat on a throne built from American silver, and his treasury held almost nothing. The silver convoys from Potosi were arriving thinner every decade because the richest veins had been cut down to bare rock, and the forced indigenous labour force had collapsed under disease and exhaustion. Wool exports from Castile had fallen by more than half since 1550, because domestic manufacturers could not compete with cheaper Flemish and English cloth-flooding Spanish ports. The artisans were gone. In 1649, a plague swept through Seville and killed nearly half the city's population, striking hardest at the dock workers, the craftsmen, and the traders who had once made it the wealthiest port in the Western world. Catalonia had already risen in revolt in 1640, and Portugal broke from the crown that same year permanently. The empire did not fall in a single battle or a single decree. It drained, transaction by transaction, debt by debt, body by body, until the machinery simply had no fuel left to turn. The merchants of Seville who survived Spain's fiscal collapse shared one documented habit. They converted silver receipts into land titles, trade licenses, and Genoese letters of credit before the crown could seize liquid assets. The Genoese banking houses, Grimaldi, Spinola, Doria, had extended enormous loans to Philip II, but they had structured those loans with collateral claims on specific revenue streams, not on the general treasury. When Madrid defaulted in 1575, Genoese creditors did not lose everything. They held enforceable liens against Castilian wool exports, salt monopolies, and Andalusian port duties, converting sovereign debt into operating asset ownership at pennies on the escudo. This is the oldest documented version of a modern distressed debt strategy, buying impaired obligations not for repayment, but for the collateral conversion rights buried inside the contract. The second group was the converso merchant networks operating across Lisbon, Antwerp, and Amsterdam simultaneously. When Iberian crowns tightened persecution in the 1580s, these merchants did not petition for relief. They liquidated Iberian holdings into portable instruments, bills of exchange, diamond inventories, and Amsterdam warehouse receipts. Mobility was their hedge. The third group was the Basque ironmasters, who supplied Spain's fleets but demanded payment in iron quotas and regional tax exemptions rather than silver coin. They extracted durable economic privileges from a desperate crown, exchanging a depreciating currency for permanent structural advantages embedded in Castilian law. Each of these three groups did the same thing in different forms. They refused to hold the asset the empire was printing in excess, and demanded instead something the empire could not inflate away. Spain's story did not end in the 17th century. It lives inside every economic bulletin published from Madrid today. Youth unemployment in Spain reached 56% in 2013, the highest figure recorded in any large European economy during the post-crisis period. That number is not a crisis statistic. It is a structural reading, a measurement of an economy that never rebuilt the productive base the empire hollowed out 4 centuries earlier. Germany manufactures, exports, and compounds industrial knowledge across generations. Spain imports capital, runs tourism as a primary revenue engine, and returns to deficit spending whenever external demand softens. Precisely the behaviour pattern of a country still living on inflows rather than output. The historical mechanism has a modern name: resource dependency, the condition in which an economy organises itself around extracting or receiving wealth rather than producing it. Every sovereign wealth fund manager, every private equity analyst, and every central bank examiner watches for this pattern because it compounds silently across decades before it surfaces in unemployment data. The silver of Potosi is gone, but the habit it trained into the Spanish fiscal system, spend the inflow, defer the reform, left an institutional memory that outlasted the empire itself. So the question worth sitting with is this: if 4 centuries were not enough time to break that pattern, what makes any nation confident it has broken its own? Empires do not collapse because they run out of gold. They collapse because they never learn to turn gold into growth. Subscribe to our channel, where every video on this channel examines what actually happened, the documented evidence, the real names, the real outcomes, so you can read the pattern before it reaches you.